Ladies and gentlemen, good day and welcome to the Gujarat Narmada Valley Fertilizers and Chemicals Limited 3Q FY22 earnings conference call hosted by Batlivala and Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal for an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Viral Shah from Batlivala and Karani Securities India Private Limited. Thank you, and over to you, sir. Participants, it seems you lost the line from Mr. Shah. Just a moment while we reconnect him again. Participants, you have the line now reconnected from Mr. Viral Shah. Over to you, sir.
Hi, good afternoon, everyone, and welcome to the third quarter and 9-month FY22 earnings call of Gujarat Narmada Valley Fertilizers and Chemicals Limited, hosted by Batlivala and Karani Securities. From the management, we have Mr. D.V. Parekh, Executive Director and CFO, Mr. Y.N. Patel, Head of Department O&M, and Mr. A.C. Shah, General Manager and Company Secretary. I would like to thank the management for giving us the opportunity to host this call. We would begin the call with opening remarks from the management, post which we will have a question and answer session. Thank you, and over to you, sir.
Thank you, Mr. Shah. On behalf of the GNFC management, we welcome all the investors to this Concall meet for the discussion on unaudited financial results, standalone and consolidated for the third quarter and 9 months ended on 31st December 2021. And the management has already placed on its website as well as the websites of Bombay Stock Exchange and the National Stock Exchange a detailed PPT presentation on the analysis of the performance and financials of the company for the third quarter and 9 months for the information of all the investors. Now I welcome Sri D.V. I will introduce my colleagues on this Concall meet. Sri D.V. Parekh is the Executive Director and Chief Financial Officer. Sri Y.N. Patel, Head of Department Operations and Maintenance, and Mr. G.I. Desai, he is General Manager Industrial Products Marketing Department. Now I request Sri D.V. Parekh to start with his opening remarks on the performance and financials of the company for third quarter and 9 months ended on 31st December 2021. Over to Sri Parekh, please.
Thank you, Mr. Shah. And good afternoon, everybody. Thank you very much to Batlivala and Karani for holding this call. And warm welcome to the analyst, investors, and others who have joined the call. Between the last call and this call, there are certain important developments which will be first covered at a cross-border level as well as at a domestic level. At a cross-border level, actually energy prices are on the boil, be it gas, oil or coal. These energy prices are supposed to be actually firing up the economies, but actually the prices are firing up themselves because of the geopolitical tensions. The situation on gas is arising mainly because of the Russia and Europe disconnect, especially relating to Nord 2 pipeline. Whereas in respect of oil, the disruption is because of the major countries commanding the supply chain, Russia joining them, known as OPEC+. In case of coal, because of the environmental reason, the availability is very limited, which is driving up the prices up. The other part is from the environment angle, there are like various agencies as well as government which are driving down the use of non-fossil fuels and encouraging non-fossil fuels. There has been a summit called COP26 in Glasgow last quarter, wherein different countries pledged themselves for reducing the emissions, etc. So these are the developments on a cross-country level. Apart from that, there is an important proxy war going on between US-Russia as well as US-China. Russia trying to command Ukraine and China trying to command Taiwan is actually creating these tensions. On domestic front, this month there is a budget announcement which mainly focuses on the capex or investment-led growth. In terms of the announcement of budget, we are affected, GNFC is affected in terms of its two products, which is methanol and acetic acid, where the duty is reduced by around 2.5%. However, there is a positive sign since the duty on oil is reduced by 2.5%. So on a net basis, we expect the effect to be either neutral or positive. So ESG front, company has been trying for garnering the support of experts in this regard. Apart from that, there is on fertilizer and chemical front, there are few other important developments. On the fertilizer front, as we know, there was a subsidy, budgeted subsidy of around 80,000 crore, 79,000 plus crore, so 80,000 rounded, which is now revised estimate is 140,000 crore. Whereas in the budget next year, it is standing at 105 crore with around 63,000 crore for urea and the rest for the others, NPK and others. As far as subsidy disbursement is concerned, the government, even after October, November, which normally dries up this time, like last year, there has been a smooth flow of subsidy. There was some build-up, but thereafter in January, there is a good disbursement of the subsidy. On the NBS front, the subsidy beyond October is also continued, so which is a positive sign, has given some breather to all NPK manufacturers, including us. So these are some of the developments on the fertilizer front. On the chemical front, the overall imports have increased except for one product where we deal in. WNA imports have reduced over the last 7 months data available in the public domain, whereas rest of the cases it has substantially increased, be it TDI, acetic acid, AN melt, etc. So this is the scenario in which companies operating both in fertilizer and chemical. Now touching upon the financial part, we'll first start with the quantitative performance part of it. For the quarter ending, the production is higher except for the methanol, which we did not operate for the cost economics reason, whereas sales are a bit lower in terms of absolute quantities. However, on a YOY basis, whether on quarterly or year-to-date basis, both production and sales are higher. The main reason for a good performance is, number one, a general increase in the realization. Two is the pricing discipline, especially on the part of IP products marketing. Three is avoiding certain pitfalls on the procurement side. Fourth is product mix, and fifth is make or buy decisions when your cost economics do not work out. So these are the basically 5 reasons which are responsible for the good performance, and the company has recorded 1427 crore of PBT and 1060 crore of PAT, apart from which are the highest ever, even considering the annualized performance of the company over the last 46 years. The revenue is just 1 or 2% down than the highest ever in the 46 years history of the company. So this is what is happening overall. In terms of the performance, when we break it down to the segment level, it is predominantly the chemical segment, which is because fertilizer we are neither expanding, and second part is a controlled industry more or less. Urea is a controlled industry, NPK are semi-controlled industry, but except for the breather on subsidy, there is nothing more to earn in that. So both taken together, like others as well as fertilizer, contribute to around 1% each, and 98% of the profit is coming from the chemical segment, whereas the revenue is coming at a rate of 68% in the quarter. So these are the overall financial performance as far as profit and loss account is concerned. Coming to the balance sheet part of it, the balance sheet is growing with the increased accruals, and it's a healthy and clean balance sheet with a size of around 9,500 crore. In terms of working capital at the quarter end, there is some build-up of the subsidy as well as inventories at the quarter end, which is chewing away the cash, and therefore the cash flow has not kept the momentum along with the profit. But in January, there is a substantial cash release because of both the factors, liquidation of stock as well as receipt of subsidy. On the future plan of the company, like we already covered in the media release as well as the presentation, there is a lined up capex of around 1700 crore. I'm talking about the rounded in hundreds of crores. So around 1700 capex is lined up over a period of next 3 years. Apart from that, there is a active examination for the bigger investment, which my colleague Mr. Vayan Patel will cover in the question answer session. So with this, I hand over the session back to Batliwala and Karani for the question answer session. Thank you very much.
Thank you very much, sir.
Yeah.
Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. First question is from the line of Neerav Jimodia from Anvil Research. Please go ahead.
Sir, I have 2 questions. So first is on the ammonia part. So how we are placed with respect to of our ammonia requirement, because it is a mother plant for our urea, ammonium nitrate, weak nitric acid. So are we currently utilizing our ammonia capacity fully with the increase in the oil prices and probably the natural gas prices, or are we importing ammonia for our urea as well as the other chemical products?
May? Okay, I'm D.V. Parikh.
Yes, sir.
See, as far as ammonia is concerned, both the capacity, gas-based ammonia capacity as well as oil-based ammonia capacities are utilized fully. We are not importing ammonia. At times, we try to do an exchange when we fall short of the total urea requirement, and if at all we import it, it is for the reason of neem-based urea production. Otherwise, it is not required. Okay. As of now, we are self-sufficient in the urea production.
Okay.
And even during the last quarter, we have been self-sufficient.
Okay. And sir, when we produced ammonia, so our first priority would be towards the urea production, and leftover would be going towards ammonium nitrate as well as the other products. And let's say if there is any shortfall, we try to cover it through import. So in terms of priority, always the urea would be the first one and then chemicals, or we have some dedicated capacities for chemicals and we do that sort of bifurcation?
No, it is not like that. See, ammonia has like 2 streams, like I said, oil and gas.
Yeah.
And both are sufficient to cater to the requirement of achieving the research capacity level of urea as well as the required production of chemical. We are not sacrificing any chemical production because of urea, because of the sufficiency on the ammonia front on the upstream.
Okay. Okay. And sir, my second question is on concentrated nitric acid. So like a few days back, there was a management interview where they mentioned that we produce more of CNA instead of producing TDI. So this was mainly because the CNA was giving us more profit. So how has been the situation currently with respect to the TDI plants, TDI-1 Bharuch plant as well as TDI-2 Dahej plant?
Okay. First, about your question on operation of the concentrated nitric acid. See, TDI, like we have two production facilities, one at Bharuch and one at Dahej.
Yeah.
At times, we could not operate for input cost economics reason the TDI-2 plant, and therefore, whatever was the concentrated nitric acid available in the upstream, there was enough market available for it, which could be sold by IP marketing at a very comfortable price. So what happened, TDI was not giving those kinds of attractive contributions, whereas at this point in time, last quarter, CNA has given more contribution than what is coming from TDI. So that was the reason TDI was not run and concentrated nitric acid was sold as a priority. It's basically nothing but a product priority, a product mix priority, which was decided.
Okay. But sir, how has been the situation currently? So are we still on the same line in terms of producing more CNA and stopping TDI sales, or has the dynamics changed with respect to the debottlenecking also, which we have undertaken for the TDI? Hello.
Participants is the line for the management. Request you all please stay connected while we reconnect the management speakers. Apologies for the delay. We have the management line now reconnected. Sir, you may go ahead, please.
Yes, sir. So my question was, how has been the situation? Yeah, sir. So my question was that how has been the situation currently? Are we still producing more CNA and producing less TDI, or with the TDI debottlenecking already completed, we have shifted more towards the production of TDI with the improvement in the dynamics?
No, TDI production has already been scheduled effective 1st February. So there are, barring for the certain hiccups in the plant, TDI manufacturing has started at Dahej.
Okay.
And in case there are certain issues of operational nature and there is an excess CNA, which is easily getting sold in the market.
Okay. And sir, with the increase in the TDI production, we would be getting some increased byproduct also, HCl. So how we are dealing with those things? Are we planning some downstream product for HCl so that we need not have to dispose it from our plant, or we would continue selling HCl in the market?
I will request Mr. Yogesh Patel to respond on this. He is from the business strategy side.
See, HCl, for selling HCl, as of now, we don't have any plan because we are able to dispose of whatever is produced.
Okay.
Earlier, we had a plan of going for DCP project, but that project is held now, and as of now, we don't have any plan for any product based on HCl. So we will be selling in the market with cost plus or sometimes even negative cost also. We are able to push surplus HCl in the market.
Okay. But that is not stopping us from operating TDI plant at the higher level.
No. So far, not a single hour is wasted on account of surplus HCl. That's not going to be a bottleneck in near future.
Okay. And sir, my last question would be if you can touch upon some of our other products like nitrobenzene, aniline, as well as formic acid, how they have done for the last quarter as well as for the 9 months.
If you want to...
See, except for aniline on a 9-monthly basis, aniline and methanol are the two products where the production has been lower than its capacity over a 9-month period. Over a 3-month period, it is only methanol which is not produced. Otherwise, all products are produced to its full capacity.
Okay. And sir, with respect to the nitrobenzene, if you can touch upon that.
Nitrobenzene is an upstream product for aniline.
Okay.
So there also we cater predominantly for aniline, and we also sell outside in the commercial market, and that market is well served.
Okay. Thank you for answering the questions in detail, sir. I'll join back in the queue if any.
Thank you. Question is from Tejas Shah from Unique Stockbroking. Please go ahead.
Yeah, the TDI bottlenecking, sir, what we have done, there you are saying we will increase the turnover of around 400 crores annually. So that project you said it started, correct?
Since last quarter, yes, debottlenecking is completed. Now the plant should start manufacturing at a higher level than earlier one.
And what is the profit margin that we get on a TDI?
No, these are sensitive, product sensitive and price sensitive questions. Okay, so we will not be in a position to answer what is the exact profit margin of TDI.
In this quarter is already out, so if you can share, I don't know.
Okay, there are positive contribution in TDI, both 1 and 2. This is what we can say. Okay, the level of contribution will be little price sensitive question, so we are staying away from it.
Okay, fine. Okay, thank you.
Thank you very much. Next question is from the line of Rajiv Shah from KC Securities. Please go ahead.
Good afternoon, sir. I had 3 queries, if you could answer, please. Number 1 is, as by God's grace, the COVID menace is on the decline. Should TDI demand pick up more than what it was for the past 2 quarters? Secondly, if the international oil prices are going to touch 100 as what they are forecasting, how much proportion should it affect our company? And thirdly, the last quarter of the coming year, should it be on the same line? I know you cannot give exact figures, but can we be optimistic about the future of our company, sir?
Okay. First on the question is on TDI demand. I request our IP marketing head, Mr. Jiten Desai, to answer this.
Yes.
Good afternoon, Mr. Shah.
Thank you, sir.
TDI is basically used for the comfort products that you know, for mattresses and furniture.
Right.
And that is whenever there is some recession or some COVID-like natural calamity, the first to hit is the comfort products demand. And that is why TDI demand was suppressed due to the COVID. And it was up and down, I would say, in last years as the waves, like the wave up and down. The COVID intensity was remained up and down during these last 2 years, and so as the TDI demand. But now you have rightly said that with the subside of COVID, the demand should increase.
Okay, sir.
Your next question was regarding the oil and its impact.
Correct.
Okay, so oil definitely will have impact, but the current spreads are having cushion. So we should be in a position to wither away any crisis because of any conflict which might happen and disruption because of that in the oil supply, whether from like Russia, Venezuela or OPEC countries.
Okay. Thank you, sir.
There was a third question.
Yeah, my third question.
About
my third.
How do we see
the coming quarter coming, sir? Please, because this quarter, last quarter, the results were excellent. And I'm talking about
the quarter.
Okay. Thank you, sir. Thank you.
Rajiv, does that answer your question?
Yeah, I just wanted to, from a shareholder's angle view also, how would be the last quarter? What should we expect? If they are not in a point to give any light on that, so be it, yes.
We have given a qualitative answer that is going to be stable. We can't quantify it for the reasons known to you as well as us.
Yes. Thank you, sir. I think you have answered all my queries, sir.
Okay.
Thank you very much. Next question is from the line of Deepak Chitroda from Phillip Capital. Please go ahead.
Thank you and congratulations first of all on the good set of numbers. My first question is on the ammonia side. As you previously explained about that we produce ammonia on a gas based and this oil based. So if I understand it correctly, whatever the ammonia which we are basically producing from a natural gas is basically used to produce urea, right? And there is no excess ammonia which we have as of now. which basically are utilizing, for chemical business. And, whatever the ammonia which we are producing out of oil is basically used for chemical products.
So there is no shortfall as of now, like we explained. Do you want to know the quantum of ammonia?
Yeah, so basically my question was that, the ammonia which we are using, for urea is basically a subsidized gas, right? So my point was that, are we using the subsidized gas, to produce the chemical products?
No, we cannot, because there is a government guideline through DOF, the Department of Fertilizers, that all subsidized gas has to be used for production of urea by default. We cannot use that for chemical at all. For chemical, we have to produce both feed and fuel is either oil, gas or coal at market price.
Sure. So basically whatever we are producing is basically entirely used for urea production, right?
Yeah. Yes, subsidized gas is meant for urea only, and of late what has happened, even this subsidized gas, the quantum has reduced substantially. We use around 1.25 million SCM a day, out of which very small proportion is of a subsidized gas. Okay. So majority of the gas is therefore RLNG, which has to be used, and at times you have to source through beyond contractual commitment through EPMC.
Okay, understood. Sure. And my second question is regarding the capex. You mentioned about 1,700 crores of capex over the next 3 years. So, of course, you highlighted the ongoing project which is already there on the CNA and formic acid, and also you talk about future projects. So, can you just quantify the timeline for those?
Next 3 years.
Yeah, all the products which we are basically thinking about.
Okay, the specific answer to your question, the formic acid should be operational by March. Okay. The concentrated nitric acid should be up and running by October, November this year. And the rest 3 major one, like weak nitric acid of 200,000, ammonium nitrate of 100,000, and ammonia of 50,000 should be operational in next 3 years' time.
I see. Okay. And so roughly, how we can look at this capex in terms of, for example, in terms of contribution towards, say, in terms of revenue. So as you mentioned for the ongoing project, but if we look at the entire capex together, can we accept asset turn of more than 2 times?
Okay. The capex will result into 2 things. One is the cost reduction part, and second is the top line part. But the overall IRR which we consider is between 10 to 12% post tax.
Okay.
Minimum.
Okay. Sure.
And whenever such IRR is not there, then we take decision based on the other reasons like strategic reason. It is not always necessary that it has to match that criteria, but exceptions have to be carved out for different reasons.
Sure. And so my last question is basically on the margin. Of course, we had a good amount of margin this year because of the good relation across the commodities which we have seen. But if somebody wants to look at over a long term to medium term, like say, what could be the sustainable margin profile which we can have over the next 2 or 3 years down the line, where, we can work with, of course, capex, which we have already announced, will definitely going to support to some extent to that side. But what could be the sustainable, margins going forward, which we can look at?
Okay. Regarding margin, as far as quantification is concerned, it will not be possible to give any definitive quantification on the level of margin. Okay. But we expect, given our history, given our strength, of ventures we have, we should be earning more or less what we have been earning so far over these years, and gradually adding to that. And on a turnover to profit ratio, it should improve. The bottom line should improve over a period of time.
No, I was asking because we have seen quite volatile, obviously in terms of margin because of the the commodity nature of our business. So if you look at over the past 10 years history, most of the based on the gas or oil prices, we have seen quite volatility in terms of our earnings or margins.
So that is exactly the reason we are not trying to quantify, because there is no certainty on any part, whether output part or input part.
How product mix is balanced in such a way that part can be.
Okay. And so last thing, if I can add regarding this, the fertilizer business. So as I understand correctly, sir, we just have in A&P, we just produce this 2020 grade, right? That's the only grade which we have in the portfolio.
Yes, 2020-00.
Sure. And any plans to add any further grades going forward?
In fertilizer?
Yeah.
No.
Sure. Thanks, sir. Thanks for the answer.
Thank you very much.
Except for fertilizer trading, which we are planning.
The next question is from the line of Nitesh from Prabhudas Lilladher. Please go ahead.
Hi, sir. Good afternoon, and thank you for the opportunity. And congratulations to the team on a very good performance in Q3. So my question is that as I understand, GNFC is the only manufacturer in India for products like acetic acid, TDI, aniline, formic acid, etc. And while the balance requirement is largely is all imported. So is the spread benefit coming through for the company in the current inflationary environment due to higher ocean freight costs, which is pushing up the landed prices of the products which are exclusively being manufactured by the company?
Actually, there was some disruption in your voice. Will you please come again on your question very clearly and crisply?
Yeah. Hello. Am I clear now, sir?
Yeah. Now, let me repeat your question. You are saying that we are the only manufacturer in certain products like acetic acid, formic, aniline, etc. Okay, this is what we heard up to. Now, what is your question with respect to that?
Yeah. So my question was, so we have seen the spreads, being at very high levels, which is actually resulting in a very strong profitability for us. So, is it basically, because of the inflationary environment, with regards to the ocean freight costs, which is basically pushing up the landed costs of imports, and which is driving this extra profitability for us, in the products which are being exclusively manufactured, by the company. And to that extent, would it be temporary, or is there something structural also, which can provide support to these spreads when the freight costs cool off?
No, it is difficult to say in future how it will pan out. But then, if the feedstock and fuel cost is rising for everybody, market has to accept and price the product accordingly. What the benefit we are also currently reaping, number one. Number two, because of this integration of the complex, we are in a position to juggle between or amongst the product. And the third is conscious kind of procurement. So, given all the levers, we will try and see how the margin can be maintained or enhanced.
Okay, sir. So my next question is, what restricts other players to get into some of the products that GNFC has been doing manufacturing exclusively for last many years? So as we see, the company's profitability in chemical segment has been fairly healthy. If you see the last 5-6 years especially. So what is it that we are doing better or differently compared to others, or do we have any technology tie-ups or any exclusivities as far as some of the products are concerned?
Okay, in our presentation we have already given who are all the partners for the technology tie-up, and for certain products like acetic acid, even aniline, the technology is not so easily available. Okay, the people who invented are actually manufacturers. Somehow we have got this technology license and we are manufacturing. Apart from that, the kind of setup which we have is making it possible to manufacture in a cost-effective manner. So these are the results as a result of which.
Sure. Okay. Thank you for this. And so one more thing. So on the import duty side, in the initial part of your remarks, you had mentioned that it will be this reduction of import duty on methanol and acetic acid in the budget. You mentioned it will be either neutral or it will be positive. Did I get that correctly? And I just wanted to understand, how will it be, positive for us, given that the duty reduction would make imports more competitive.
Okay, see, for both this product, methanol and acetic acid, we have to price our product at IPP. So it is going to be somewhat competitive. But at the same time, the feed, which is oil, the import duty has reduced, and we have already negotiated the price with the supplier, the benefit of which is going to come. So by and large, we feel that the effects should be neutral or positive. Because of the price dynamics, it is not possible to quantify the exact impact except on input. So on input, we have already quantified internally, and based on our experience, we know that it will at least be neutral, if not positive.
All right. Okay. And sir, maybe one last thing on the capex. So given that we had 2,000 crores plus on our balance sheet in the last reported numbers in September quarter, and after that there should have been addition to this cash component. I mean, has it increased, or I mean, can you give the cash on books figure as of 31st December?
The cash on books as of December is around 2,500 crore rupees.
25.
Regarding the deployment of which, apart from the already planned capex, the business strategy group is already examining certain capex of high value, which will take some time to come in shape.
Okay. Any color that you can give on this high value capex and the quantum, if you can, any ballpark number that you can give? I mean, apart from the 1,700 crores number that is already finalized.
See, as you have heard in an interview by our managing director, we already have a lined up plan for 3,000 crore capex, which will be through within next 3 years. That is by 26. Now we are also working on duplicating some of the existing chemicals, which you said where we are number one or we are only producer. But as a long-term plan, since we are a cash-rich company, we are also under pressure that how best utilize some of this cash. So our long-term plan is we are planning for naphtha-based cracker complex, where main item will be ethylene and propylene, which are always in short supplies, and all downstream products depending on the feasibility study which is underway. So depending on that, we are planning for large capex in the range of 12,000 to 15,000 crore, which is a long-term plan, and it depends on how what is the outcome of our feasibility report. So this is our both short-term and long-term plan. We are going to move ahead.
Okay. So that's very helpful, sir. Thank you so much, and all the best for the future progress. Thank you, sir.
Thank you very much. Next question is from the line of Urvila Shah from Isha Security. Please go ahead.
Hello.
Yes.
Hello. Am I audible?
Yes, clearly.
Yeah. Yes, congratulations team for the good result, and thank you for an elaborative presentation. I think this is the first time we have given this elaborative presentation, and I hope that we continue it. I think, sir, a lot of my questions about capex and margins you have answered. So, sir, I think, can you just confirm that what can be sustainable margins? You said that we would be trying to improve it in the coming quarters as well. So, is that understanding correct?
Would you like to answer? Future margin. Margin. This is already explained. Ma'am, this is already explained. Is there anything further you are looking for?
Okay, fine. Okay, I'm just confirming. You said that...
Because what has happened, we cannot give guidance of a quantified nature because of the regulatory restriction. That is the constraint.
Okay. Sir, also I wanted to understand about the dividend policy. I think last year we had a payout of 18%. So what kind of dividend are we looking at? Is there a policy that we follow?
I will request our company secretary to respond on this.
Madam, our company is a consistently dividend paying company, and except for 1 year, all through the company has been paying the dividend, good return to the shareholders, investors, and we expect to maintain that tempo for the present current financial year also. However, it is not advisable to quantify because of the regulatory restrictions, right? But the management, considering the consistent and uniform long-term dividend paying policy, the company has already placed on the website its dividend distribution policy as per the regulatory provisions. So in line with that, we will definitely, management will continue to reward the investors in a fair manner.
Okay. One last question I had was, post the capex, the 3 years capex that we have referred in this call, so what can be the revenue breakup between our two segments?
The entire capex will result into a revenue increase and profit increase in chemical segment. Nothing on the fertilizer side.
So the ratio will definitely go in favor of chemicals.
Okay.
Apart from that, we are also thinking into the line of trading of fertilizer, which probably will ramp up the top line and some bottom line into fertilizer front. But it all depends upon the kind of opportunities, because currently the imports are very dearly priced, and importer will be making losses in the domestic prices.
Okay, thank you, sir.
Thank you very much. Next question is from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity, sir. My question on the energy cost during the quarter. So, can you confirm us this current quarterly energy cost reflects the underlying market rates, or any low-cost inventory also benefited the P&L?
No, it's market rate driven.
No, market
the
rate.
Power and fuel cost is totally market driven.
I mean, point is the coal price and the gas price, the current market rates are suggesting. So we do not have any benefit of low cost inventory which we consumed during the quarter, and because of that, the P&L is energy cost on a lower side.
Not significant. You are talking about probably the weighted average price which gets reflected for different procurements. Okay. Of course, there are, because of the rising prices, the cost will go up. But then it's a dynamic, and that effect is significant.
Right, sir. Right. Understood. The second question on you said in your opening remarks that one of the factor of better performance of chemical division is a product mix. So, and we have shifted certain volume from TDI to the CNA. So that mix will continue in the quarter 4, or that will change materially, and that can have an impact on the overall operating margin of the chemical business?
The product mix is an outcome of a response to a situation.
Okay.
So depending upon the situation, we respond to it by changing our product mix.
And last point, sir, in terms of our key product realization during the quarter and the current product realization trend, so any material change of the price trend, if there is a material, you can highlight us.
No, since we are saying stable, see, we are still like at the beginning of February. And secondly, realization part is again a price sensitive part. So we cannot comment specifically whether realizations are improving or what. Okay, there are like information available in the specific public domains which may be referred. But as far as we are concerned, we will not be in a position to comment on the price realization part of it.
No problem, sir. Thank you. Thank you for the opportunity.
Thanks. Yeah.
Thank you. Next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. Sir, I joined a bit late, so forgive me for the repetition. Sir, firstly, what are the projects that will be commissioned in this financial year, and what is the plan for the next financial year, and the capex on the same amount to be spent?
May we request that if you refer to this Concall transcript, you will get the answer to this. But
okay. Right, sir. Sir, can you give me some color on the current?
Otherwise.
Hello?
If you are okay, we may do like that.
Yes, sir. It is okay with me, sir. It is correct on your part, sir. So, what are the current prices of the key products post the exit of the December quarter? How has been the price trend of our key products in the international market?
Price, regarding price, they are asking.
Price trend, sir. When we exited the December quarter, the key product prices, and currently, how have the trends been for the prices of the key products?
No, see, price trend, like we have, this is the third time we are reporting. The price trend is indicative of certain price sensitivity, okay? So, you may get that from the public domain rather than from us.
Okay, sir. Sir, actually, we are getting it from the public domain. It was just a confirmation on part of investors to speak directly. We get an opportunity to speak to you. So, we were just trying to get some sense whether the premise of this increase in trend is also being substantiated by you. That was the only reason. We have, price trends are available to us also, sir. You are right. It is in the public domain. So that was I was just trying to validate the same from the management. कि price trend December quarter के बाद key products के कैसे हैं? Positive trajectory में है कि negative?
Gentlemen, you are right from expectation point of view, but we are constrained because of the regulatory requirement.
Correct, sir. Correct.
Okay, we will be happy to assist you otherwise, but then we have to consider first the framework.
Correct.
Legal framework.
Sir, coming to my last point, sir. Sir, these are unimaginable times for companies like us, and especially, sir, for investors, value creation ideas. These are times when the management should sit across the table and get the best minds of how to create or unlock value, because these trends are repeated, are not. We do not have a past inference of it, that prices and the profitability of companies like the one which we are in the domain getting these kinds of profits. So there should be profit sharing ideas also that should be well documented to the investors. Just like that we have seen in the case of DIPAM, where all the central PSUs have been advised, or in fact, if I use the word directed, to distribute X amount of profit or X amount of profit up to the net worth with the investors. But since our being a state PSU, we do not fall under the domain. we should try to contemplate with the government of Gujarat coming up with policy changes with the change of times that as the earlier speaker has asked for the different parts, there should be well documented this different distribution policy. Sir, today you are speaking about capex of 12,000, 10,000 crore, but you are unable to speak of a different distribution policy. So there lies the anomaly, sir. So just requesting the state government authorities to get the records, set things on record, that there should be a process by which the investors should be aware of what kind of profit will be distributed to us in form of dividends as well as from buyback. Buyback should also be a part of distributing cash to your investors. So investors not only look for growth, but also look at regular cash to be distributed to them. Because in this journey, chemical sector journey, there will be times of ups and downs, and we have seen our company also going through rough times. So that was the thought process, and please convey the same to the board so that things should be deliberated at the government level firstly, then only it can float, it can come top down. So that was my small understanding. And also, sir, I would also request to this forum that the government of Gujarat should also look at unlocking values through the holding which all state PSUs are holding in them. They invested in the company for a specific purpose. And today, with the type of market capitalization these companies are commanding, the value has risen by many folds. So something should be decided on the basis of which that money should also be returned back to the government as well as to the shareholders. So this was the thought from my side, and I hope and wish the best to the team. Stay safe. Thank you.
Yes. I'm happy to inform that we definitely welcome your suggestion, and we'll take up it with appropriate forum through the top management. At the same time, we would like to mention that the company operations, being a listed public company, there is no intervention of the management, direct or indirect, in the determination of market price of the share. It is freely driven by the demand and supply, the forces in the market. Secondly, that the company has always been considerate and positive in rewarding the investors, and over a period of time, it is noticeable, quite apparently means clearly noticeable that the investors' value has definitely improved much and far better level in the past years. The current price is hovering around 500 rupees per share, right? That is the biggest enhancement of the shareholders' value. At the same time, last year, considering the top line and bottom line, especially the bottom line of the performance of the financials of the company, the board of directors, of course, it is the prerogative of board of directors to recommend, after considering the performance, financial parameters of the company, and the final approval of the shareholders to pay the dividend. Last year, you must have observed that there is a substantial increase in rewarding by way of declaration of higher dividend, 8 rupees per share, by the management, right? So management is definitely concerned for giving better returns to the shareholders. At the same time, the company, I also mentioned earlier, that the company has already framed its long-term dividend policy, which is already placed on the website of the company. And on the basis, within the framework of that policy, definitely management and the board of directors will try to reward in a fair manner to the investors in the times to come.
So what would be the replacement cost for our
Sorry to interrupt, Mr. Possible. Please request you to return to the queue for your follow-up questions as we have several participants.
Yeah, definitely. I'll join the queue, sir. Thank you for again, sir.
Next question from Rajiv Shah from KC Securities. Please go ahead.
Yeah, thank you once again. I just wanted to ask, is there any possibility of the company splitting its two businesses, mainly fertilizer and chemical, into two different sections, whereby the chemical sector, which is doing so well, and all chemical shares have got very good valuation. They mostly are all talking in terms of P, they are all rating at 15, 20, 30 P, whereas GNFC at the moment, even with today's closing price of 560, is commanding a P of only about 7.5. That was my first question. And second question, is there any plans to subdivide or make it into a two paid-up share, whereby the liquidity increases and small investors can also invest in your company?
Okay. First, about your second question about division into share with dematerialization of the shares.
Yes,
there is no much question of liquidity issues in the share. Second, your first question is regarding splitting the business into fertilizer and chemical.
Yes, please. There's two different shares of, like for example, GNFC chemicals and GNFC fertilizers. Two. Is that a possibility? I'm not a CA or anything. This thought came to my mind, so I wanted to share with you and ask you, please.
From the structure point of view, conceptually you are right, but practically it is not possible given the nature of our operations. These are integrated operations, and therefore we cannot have those kinds of different setups and split the businesses into two. If you have been the regular remnant of the call, a couple of quarters back, the same question was asked by somebody, and we responded in an elaborate manner on this.
Okay. Because I think once a stock gets split, for example, GSFC is a two paid-up share, then GMDC is two paid-up share, and then that way, I'm just talking from the angle of benefit to the shareholder, the valuations increase. My reason to ask you was because GSFC and GMDC are two paid-up, whereas GNFC and Gujarat Alkali are 10 paid-up.
You are right. Mr. Shah, it doesn't make a difference whether you have a 2 rupee share or 10 rupee share with scenario of dematerialization.
Right.
As far as the total value is concerned, it is divided by the number of shares. Okay.
Right.
So
no, you are right.
Shares will increase fivefold if we divide by 2.
Right, sir. Yes.
So these are the not fundamental changes which we are looking at. Okay, dividing the share into 2 rupees and all.
See, basically, it is, splitting is nothing but, it is a psychological advantage which is passed on to shareholder.
True.
So these type of practices are indulged by company, who are, speculative in nature.
Okay.
So because different from, all such type of practices. So we believe in concrete growth.
Correct. No, I asked this question only because GSFC and GMDC were two paid up, which is, I think, your sister company only of Gujarat. That's why I put this question. And in fact, I would be happier with it remaining at 10 paid up.
Thank you.
Yeah. Thank you, sir.
Thank you. Sham, thank you.
Yeah.
Next question is from the line of Viraj Mahathevia, an individual investor. Please go ahead.
I had a question, sir. Thank you and congratulations. Excellent results. Company is well placed, it seems. What part of revenue increase in 9 months of FY22 versus the previous year has come from volumes versus price?
Our IP marketing head, Mr. Jitan Desai, will respond on this question.
Our sales volume, we call top 10 products. We have total 22 chemical products, and 10 products we said is the major products. Other products are either co-products or intermediates. So for top 10 products, the volume has increased, sales volume has increased by 4.3%, whereas sales value has increased by whopping 90%.
Right. So you're saying the top 10 products which are most indicative, large part of the revenue increase has come from price increases and not volume increases. Is that correct?
Yes, that's right.
On a quarter-on-quarter basis, you are right, which was covered in the opening remark as well, that although there is an increase in the production, there is an accumulated inventory and sales has been relatively little lower than that of the previous quarter. However, on a YOY basis, both quarterly as well as 9 monthly, there is an increase in the sales and production.
Yes, sir, but it seems like your volume increase is only 5%, right? Irrespective, that would get captured in your production. Your volume increase is only 5%, so 90% plus share of your revenue increases has been on the back of pricing.
Yes. It is not entirely true to make this kind of statements. However, in a major way, you are right. The other angle is that of the product mix. Okay. For example, when we sacrifice something, like we sacrifice methanol production, okay, we bought it out from outside. So apparently there was a reduction. But overall we made a better bottom line out of it.
Yes, sir, which is why I asked the question on a revenue basis and not an EBITDA basis, right? Product mix would not make a difference at the revenue level, but an EBITDA level it would make difference.
I'll tell you how it makes. Let us take the case of a swap between TDI and CNA. Okay? CNA price is less than 1/3 of that of TDI.
Okay.
So what happens when you manufacture more of an upstream product? It makes a difference on the top line, and it makes a altogether different difference depending upon the decision on the bottom line. So it is not that it doesn't make difference on the top line. This is the befitting example of how it makes difference on the top as well as bottom line.
Understood. Very clear, sir. Thank you. So you're saying it's not as skewed as this, but it's clearly more skewed towards pricing for sure. I think that's apparent.
In a major way, yes, you are right.
Okay. So
and price increase is on both the sides. See, on the input side also, if you see, they have gone into 3 digits. Price increases, whether of gas, oil, even other products which we are consuming, rock, benzene, toluene, from 2 digit to 3 digit, the increases are there. But end of the day, either the margins are maintained or enhanced, depending upon the market opportunities.
Understood, sir. Can you elaborate on your thought process around the capacity expansions that have been planned over the next few years? Is it driven more by import substitution or ability to import China plus one?
There is some background noise which is coming, so we did not hear out clearly. Capacity expansions.
Yes, sir. Can you elaborate on the thought process around capacity expansion?
Yes.
Is it driven more by import substitution or creating an export opportunity with China plus one inquiries?
No, more kind of an import substitution.
Okay, sir. And lastly, this question has been asked, but maybe I'll ask it slightly differently. Last few quarters, we've done EBITDA margins of 21, 26, 29%. Would you say a sustainable EBITDA margin as a range of 21 to 25% is possible?
See, would like to clarify.
Yes.
Sorry, this is Ashwin Shah. I would like to clarify that most of our products are market driven, and considering the major chunk of revenue and margins coming from chemical products, which are mainly demand driven products, market driven products, it is difficult to predict in a concrete and concise manner, right? So, but we are quite hopeful to at least maintain the stability in our supply chain management, and the earnings.
Right. Okay. Which is why I asked for a range, sir. I know this is difficult to predict. There are many moving parts. But, I think all analysts would like to at least be able to forecast some kind of range. And 3 to 25% is still a pretty large range and is 4% lower than what you've delivered this quarter. So my question is 20 to 25% sustainable?
Okay, for that, for a range, see, this being a cyclical nature of a business, you can refer and take last 5 years average, which should be maintainable. Please don't go on a quarterly basis, go on a yearly basis.
Right. Okay. Thank you very much. All the best.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to the management of Mr. Parikh for closing comments. Over to you, sir.
For the closing comment, we hand it over to Mr. Shah, our company secretary.
Yeah. On behalf of GNFC management, I would like to express my sincere thanks to the investors for posing their confidence in the management. And at the same time, I extend my hearty thanks to Batliwala and Karani for making this event, Concall Investors Meet, a grand success, and hope the management has been able to explain and clarify the queries to the satisfaction of investors to enable them to make conscious decisions on the their investment decisions. Right? Thank you one and all for this successful Concall meet. Thank you very much. Bye.
Thank you very much, members of management. Ladies and gentlemen, on behalf of Batliwala and Karani Securities, that concludes today's conference. Thank you for joining us, and you may now disconnect your lines.